Okay, in this tutorial, I'll be going through with you the symbol FISV, and I'll just copy that and paste it in Google and type it stock. And you can see on the left hand side there's information from Google, and on the right hand side information from Wikipedia. And if I want to buy the stock right now, I'll just look at the Google and it says 94.23 and it's in US dollars, which is a currency, for one stock. And if I want to know when was this founded, I can just have a look at Wikipedia and it says founded 1984, July. And if it's not written outside, I can just click in Wikipedia and there's a box there and I can just say founded and it's 1984. Okay. And I'll just let you know that there's one website called Macro Trends. I'll go through with you four ratios that are very important according to me. I think so, which I have used. So I've just left the link in the description and I'll explain you briefly. So when you click the link, this thing will appear and then you click in price ratios and price book ratio and then search in the symbol and click the name. Make sure the name matches the symbol and the price book ratio. Now, what is price book ratio? Book value is the real value of the share, and stock price is the market value, market price. So, for example, if the book value is $1 and the market price is $2, it means that you're paying $2 to buy something that is $1 worth. It means you're buying something expensive. If you look at price to book ratio, if the price to book ratio is less than 1, that means that the stock is at bargain, it's undervalued, and it's at bargain. You're getting it at a very cheap price. If it's 1, then that means that you're buying it for exactly what it is worth for. So you're not buying it expensive or cheap, it's exactly the worth you're buying, which is also good. But if it's more than 1, that means that you're buying an expensive stock. You're paying more for something that should be you should pay for less, and it's an expensive stock. And the higher the number goes, the more expensive it gets. Right now, we have July data until 2019 and it's 15.44. That means that it's 15.44 times more expensive than what its real worth is. So the stock is really expensive right now. If I just have a look at 2008 June, it was 2.62 times, 2.62 times more expensive. So people who bought that time, they got the stock 2.62 times expensive. But people who will be buying now, they'll be getting 15 times more expensive stock. So you need to be aware of that. Now let's look at other ratios and current ratio. Current ratio tells us that if the assets are more than liabilities, which is very good. If the assets are more than liabilities, then the ratio is 1, more than 1. If the assets are less than liabilities, then the ratio is less than 1. If the ratio is less than 1, then it's dangerous because the liabilities are more than assets, which is not very good. And if the ratio is more than 1, that it means that, which is a good picture because the assets are more than liabilities. But we are looking for a margin of safety here. We are looking for a stock that is less risky. There's not much risk. So make sure that the ratio you're looking at is 1.5 or more than that. Right now it's 1.07. This means if you just see vertically up, you can see that the assets are still more than liabilities, but it's 1.07. It doesn't provide us with margin of safety. It's still very risky because assets are not too much more than liabilities. So you need to be careful about that. So you are looking at only 1.5 or more than that for it to be safe. And if I just go back and see the trail, and here if you see it's zero point 0.9, it's less than 1, which means the liabilities are more than assets, and you can see it vertically up, the liabilities are more than assets. So it's dangerous, it's a risky stock. I'm not saying that the company is not doing good, or I'm it's just telling me that it's risky to invest in. There's very less margin of safety. There are more liabilities than assets. If I just go back and it's just fluctuating, and just once or twice it has been up one above 1.5, and it's so nearly every time it's below 1.5, and sometimes it's even below 1, which means that sometimes the liabilities have been more than assets. So you need to be careful about that. Now let's look at debt equity. Debt equity tells us that if the company is mainly operating on debt or equity. If it's operating mainly on equity, then that's very good for the firm. If it's operating mainly on long-term debt, then it's risky. So the ratio we are trying to get is zero point 0.5 or less than that to give us good margin of safety. Right now it's 2.45, which means that the long-term debt is nearly 2.45 times the equity. So there's a lot of debt compared to equity, so it's very, very risky to invest in this. If you see just vertically above, equity is 2.39 and long-term debt is 5.87, which is nearly like 2.5 times more than equity, which makes this very risky, dangerous. If I just go back, it's 2.6, which is again, you know, way, way more than zero point 0.5. We are looking at zero point 0.5, and let's see the consistency. So it has operated like nearly like so since 2007 June, it has taken, before that the debt it has taken was fine, but since 2007 June, the nearly all the time the long term debt has been more than the equity. So they're operating mainly on long term debt, which is very risky stock. It doesn't mean that the firm is, everybody have their own strategy. It doesn't mean that they're doing bad, but that means that it's very risky because they are operating, like, it's been now from 2007 up till now, they are operating mainly on long-term debt. uh, you know so it's like nearly 12 years and they're operating on long-term debt, which is very risky stock. Let's go to return on equity. Return on equity should be 8% or more than that for it to have to be really good. Right now it's 38%, which is brilliant. It's more than 8%. Let's look at the previous trails. So it has always been more than 8%. So it means that the equity is very good. It's bringing in good returns, so which is a good picture. And we're looking at 8% or more. And since 2005, we have the data. And since that, it has been more than 8%, which is brilliant. Now let's see if this stock gives us any dividend. Let's see it in Google. And if I just Google that, I can see dividend yield. There is not applicable. There's no dividend yield. Um, if a firm gives a dividend, even if it's a small percentage, that shows that the firm is able to generate finance, enough finance to not only pay off its, after paying all the bills, after paying their creditors, after paying every cost, they have still money left that they can pay that off as dividends. So this is a positive sign for a firm that who are able to pay dividends, because it means they have extra money left. So which means that they are able to generate so much money that they have extra money left to give away to their shareholders. But this firm don't have any dividend yield. So it doesn't mean that the firm is not doing good, but if a firm has a dividend yield, that gives us a very positive news about their finances, that they are able to generate a lot of money, extra money. So it doesn't have any dividend. Let's see if it has any patents. I'll go to Justia Patents. I've left the link in the description, and you just click that link. It's easier for you, and copy that and paste it. And I'll just click search. And what I'm more interested in is applicant or assignee. That would interest me. I'm not interested in inventors, because inventors are people who invented it, which is brilliant. But applicants or assignee are the people who own the rights. So we are talking about people who own the rights of the patent. So we can see in 2013 it has filed a patent, and we can see in 2013 again April, then in October 2012, August 2013, December 2012, and so on. You can just go through it. It's a big list, and you're just concentrating on applicant and assignee. And it's a big list to go through. And that's the assignee, which is the person who has the all the rights of the patent. They have a recent one in 2017, so you can just go through the list yourself. um, so the point is that make sure that they have recent patents as well in 2017, 18, and 19, because sometimes a firm, when they start, they are innovating, they have patents, they have the stuff, but then they stop innovating, which is not a good idea. So you need to be careful that they have recent patents, which I can see they have in 2017, which is a recent one, 2017 May, again 2017, and you can just go through that. So patents are very important for the firm because it provides competitive edge. It acts as a moat, and it means that the firm is doing their best to. They're innovating, and firms that innovate, they thrive for long term. So this is a brilliant news that they have patents, because that means that they can, you know, they can thrive in competition and succeed. And let's look at Yahoo Finance. I want to see if they have, if the executives of this firm have their salaries shown or not. So I'll just go to profile right now, and I'll show you one more thing. If you see the sector, it's industrials, and industry is business services. Full-time employees is 24,000, and they have five executives, key executives that are main people, and all of them have their salaries shown, which is brilliant because the more transparent, the more information we have, the better. It builds trust, and it shows that um, they are more transparent, and it's better, and you can see all the salaries, stuff like that. And lastly, I want to see if they have any reviews from the employees, what the employees have to say. So I go to Indeed review, and I'll click there, and they have nearly 1900 reviews, and they have 3.5 stars, which is brilliant, which means that they are doing really good. They're 3.5 stars is really good from nearly 1900 employees, and you can read through the reviews yourself. And lastly, I think Glassdoor is really good for reviews as well. So I'll just click on Glassdoor, and I can see that they have like nearly 2900 reviews, which is nearly 3,000 reviews, which is quite a lot of reviews to judge a firm, and it's 3.5 stars average, which is brilliant from 3,000 employees. That's brilliant. And do I have anything else to show? No, just that.